Hi, I'm Roelof and Dijk, Executive Director of the Real Estate Forums with Informa, and welcome to 10 Minutes with David Ward, Executive Vice President and Chief Operating Officer for Canadian Urban Limited. We might go a little over 10 minutes today, and that's perfectly fine, David. But obviously, there's a lot going on with commercial real estate right now, from issues in the different sectors, such as the office sector, what have you. But some other big issues with liquidity and capital raising that everyone's really interested in, and I'm sure we're going to get into today. But perhaps it would be best to start with a little about Canadian Urban Limited. So I understand Canadian Urban Limited is independently owned entrepreneurial real estate investment and asset management firm. You guys specializing in Canadian commercial real estate, but for those in our audience that don't know much about you guys, maybe give us an idea of where you operate geographically, what type of asset types you look at typically, and then typical asset values and fund values.
Thank you, Rudy, and I'm really pleased to be here today and given the opportunity. I've been with Canadian Urban for 2.5 years, and it's been a really fun experience. I came over from a much larger real estate investment firm. Canadian Urban has been in business for over 50 years, 52, I believe. And our assets under management is about 1.2 billion. We have 43 properties, 3.5 million square feet. It would be in all different asset classes, and we manage properties from Halifax to Vancouver. Our team consists of about 55 people. Our head office is in Edmonton. I'm one of 12 that's based here in Markham. It's really, we manage all of our properties. We're fully integrated. We have a property management, facilities management, asset management, and investments group. We manage all the properties directly that our investors own, and we take real pride in that. We have 15 clients. They consist of pension funds, university community foundations, private equity, high net worth. Matter of fact, this morning we got off the phone with our singular European client who has been working with us for a number of years now, and are quite committed to Canadian Urban going forward. And we're really what I think differentiates ourselves is that we're a mid-market player. We invest in individual or small portfolios, individual assets or small portfolios, typically between $20 and $80 million in value. And I think that really distinguishes ourselves a bit because we are able to be nimble. We can get 40% of our deals are off market, and we sort of avoid the mass feeding frenzy or multiple bidding process, which enables us to get accretive assets. And this is, I think, really helped us. We have a number one ranking in income returns in the MSCI index since its inception in 2000, and I believe we're like in the top 5 in total capital returns as well, or total returns. So the big thing too is our composition of our portfolio is one half of it is industrial, and when you layer in the multifamily part of it, it's 2/3 of our total book is multifamily and industrial. And I think that our portfolio composition really has helped us, especially with these turbulent times. So we're very, very well positioned going forward.
Oh, that's interesting. And to your point, I mean, this mid-tier discussion is really important because we hear a lot about what pension funds are doing and what REITs are doing, and that's all obviously very important as well. But this mid-tier really encompasses a big part of commercial real estate, the commercial real estate market in Canada. So thank you for joining us. So with all of that said, let's talk about 2023. It's been a challenging year for everyone. How's it gone for Canadian Urban? What are some of the good things that's happened in 2023, and what are some of your biggest challenges right now?
Well, I think it's I think everyone's sort of faced with similar challenges as far as, the turbulent times that we're going through with the economy, and a lot of institutional investors are dealing with the high costs of debt, and having the denominator effect is probably one of the more significant ones. And there's a big bid-ask spread. There's not a lot of product that's available. But the denominator effect, where institutions are over allocated in real estate, that's been a real sort of pens down, I guess. You hear that term quite a bit. And then the other challenge that we have is, we're a smaller boutique firm, and despite our impressive track record that I referenced, Canadian Urban is still sort of not all that well known amongst the institutional clients. Again, being Western based, and as I said, we're really trying to change that perspective by beefing up our presence in Eastern Canada, where the capital is, and so getting in and getting our foot in the door is really the biggest issue. And we now have this new open-end fund. It's called Canadian Urban 7. It's an 11 building, 1.5 million square foot portfolio, and it's right across the country, as most of our portfolio is. And it's 80% industrial with 20% layered in with grocery anchored retail. So this has been seeded by a major Canadian pension fund, Honda Canada Pension Plan, and it's been in existence since 2011. So we have what we consider to be a really interesting offering that makes a lot of sense for investors, just because of the composition, but also for other reasons I can get into. But that's been our biggest issue, is trying to get our foot in the door, and especially with this new investment vehicle. So what we've done, if I can just continue on this, we brought in what we consider to be a heavyweight in the real estate circles and investment banking. We've partnered up with Jamie Ziegel of Ziegel Advisors. And he has over 30 years experience as really, and as both a broker and an investment banker. I think he's done over 50 billion in real estate transactions. And working with Jamie, we sort of changed tacks. We originally were sort of going, well, this is a fund. We were sort of targeting smaller investors to try to, this is a 390 million in value portfolio. But Jamie's completely sort of collectively worked with us in updating and reworking our marketing materials. And instead of sort of looking for smaller investors to try to add on to Honda Canada's sort of equity and shares within the portfolio, we want to go out and try to secure larger institutional investors. Position it in such a way that this is an opportunity to partner with a major Canadian pension plan, as opposed to being a smaller player on top of an elephant or something like that. I can't think of a better term, but this is an opportunity to partner with a like-minded institutional investor who is committed to growing the portfolio, diversifying the portfolio. And so that's been a real boost for us. And we really have, got our foot in the door with many different institutions because of it. And what Jamie sort of instilled in us, it's sort of a three-pronged approach. This is the right product, the right strategy, and the right team. And by right product, it's an 11 building, 390 million national portfolio. As I said, 80% of which is industrial. But the existing rents, and we all know industrial is the darling of all asset classes. And the fact that our existing portfolio has contractual to market rent gap of 55%, there's and the weighted average lease term is just over 3 years.
Okay.
I mean, there's huge upside.
Yeah.
So whatever equity you invest in the fund, you'll get the benefit of being part of this roll up to market over 3 years. So that's sort of the saying of the right product. The grocery anchored retail is another part of it that is a nice diversification away from the industrial, but the right strategy. And as I said before, we have a mid-market strategy. Most of our deals are off market. Mid-market sector has consistently outperformed the larger portfolio deals, and we have agility and mass market appeal to these assets. And the portfolio is it's liquid as well. I mean, there's capable of achieving outsized returns, just through periodic owner user sales and redevelopment opportunities. And like we're talking about, Saint Laurent, Laval, Brampton, Cambridge, Calgary, and Edmonton. So pretty
well located,
robust markets, yeah. And then the right team. I mean, Honda Canada has benefited since 2011. This portfolio has generated returns over 16% since its inception in 2011. We forecast 12% returns over the next 10 years. And I think it really does have it's telltale that an individual like Jamie Ziegel has committed himself to this cause. And really, he loves our team, he loves our strategy, and he loves our portfolio. So we're confident that this log jam's going to break eventually with the investment opportunities. And we're continually getting in front of people, and they like what they're seeing. It's just unfortunate at this time, they're sort of in a rebalancing mode, but we're confident that's gonna change, and that we're going to be able to help them and bring them into this fund.
Yeah, and it's interesting that you mentioned about that industrial part of the portfolio, because that was going to be one of my follow-up questions. With the potential of industrial rents, rental growth is slowing, but you guys are on the other end of that. You don't have to worry too much about that because yours are coming up for renewal. Right. So some good uplift there, like you said. Now, I mean, you've already talked a bit about some of these capital raising issues, but that's clearly one of the biggest things going on. I mean, it sounds like you guys want to be buyers, but you need the capital to be the buyers first. Right. So, and that's, facing the entire industry, but how are you guys specifically handling that? And are you encountering any issues, from specific sectors or specific types of lenders, or not lenders, but folks with capital at this point, or how's it going?
Again, as I said, it really is, I think, I hate to overuse the term, the denominator effect is really in play here. But, I think what a lot of investors are doing right now is they're rebalancing, they're culling certain, assets within real estate, but also, I think they're rebalancing not just real estate, but all their other investment types. And the word we're getting with our existing clients is that, we're ready. I think, we haven't been able to really be aggressive or commit to making certain acquisitions, but I think that's freeing up. We certainly, right now we're in the throes of our business plans and follow-up business plan presentations, and it's very positive to see that many of our clients are very excited about. I think there's some optimism going forward, and especially working with us is on the horizon. But as far as opportunities go, I think portfolio composition is key. That's compelling, I think, for people to consider us. And we're bullish on industrial, multifamily, grocery anchored retail. Immigration is a really big driving force within Canada, and and I think those people need a place to live. You need to eat. You need stuff. We do have some office product. It's well positioned, and I believe it's defensible. And we have lots of lease term remaining, so I think we can withstand the pain that's going through office right now. But as I said, the longer term and the log jam that's sort of existing right now, in the investment market, I really think it's going to free up. I think you and I certainly go back really to the fiscal crisis in 2009.
Yeah.
I couldn't believe some of the opportunities that existed back then, and everyone was reluctant to pull the trigger. Now, mind you, the interest rates were quite a bit more favorable back then, but where there's chaos, there's opportunity, and we really believe in this mid-market strategy. We don't have to be part of the bigger offerings. We can carve out our own opportunities, not only with the investment brokerage community, but the leasing brokers. I mean, they're the on the ground, the boots on the ground. They certainly have the relationships, and not every vendor wants to do a mass marketing program, right? There are opportunities to price stuff loose, and that's certainly been our MO.
Yeah. Okay. So then, like you said, I guess the outlook for 2024 is the log jam's going to clear a little bit. Let me throw in a couple random questions for you then. Interest rates at this time next year, about the same as now, up, down? What are you thinking?
I think they'd be shooting themselves in the foot to continue to raise them. I think the U.S. Fed has really sort of set the journey, and we're sort of following it. And I think down in the States, if they go ahead and raise it more, I think that would be suicide for them. And I think conversely, we're going to follow whatever they do.
Yeah,
that's my simplistic take on it. But the other thing that encourages me though is the GDP growth in the U.S. Is sort of leading the free world, and we're sort of treading water a little bit. But I think it's just a matter of time for us to get out of this and follow suit. And the oil and gas sector's performing well. I mean, we're so dependent on that, and I think I think there's prospects for growth coming down the pipe.
Yeah. So no, this is really informative, and thank you very much, David. And I know obviously a lot of this is going to come up at our 2024 Real Capital Conference on February 27th in Toronto. So I hope many of you watching can hear more about a lot of this there. But again, thank you very much, David. I really appreciate your time today.
Really, I'm most appreciative as well, and great to see you again. And congratulations on your success with Informa Canada. I think it's you're the right guy, and you had some big shoes to fill.
Yeah.
But I think the industry is thankful for it. So congratulations.
Thank you. So that's 10 minutes. It was probably 15 minutes with David Ward, Executive Vice President and Chief Operating Officer for Canadian Urban Limited. So thank you very much, and we'll see everyone again soon.
Thanks, Roelof.